Hello and welcome to the Tax Roundup for August. And inside this month we're looking at the further changes to the exemption for FBT and motor vehicles from the ATO. Now remember, this is in the context of the ongoing attack by the ATO on deductions being claimed and the legitimacy of those deductions, which raises the bar for both accountants and clients as well. We're also going to take a look at a new PCG which has come out to try and tackle the uncertainty about the change in the company tax rate. Remember, the changes were supposed to come through on 1 July 2018, but the legislation hasn't passed Parliament as yet. This new PCG explores the scenario of what to do about that. But first up, we're going to take a look at new guidance from the ATO on how property developments are taxed. Across to you, Michael.
The ATO has released some new draft guidance that will hopefully assist people in trying to determine the tax treatment of property projects. So things like subdivisions, but also where things go beyond that, and we've got construction and other development activity. Now, the ATO has provided some guidance in this area in the past. MT 2006/1 is a pretty good source of guidance when you're trying to look at whether a property project might be on revenue or capital account. But this latest form of guidance goes beyond that and really expands on some of the factors, the practical factors that you would need to take into account. And certainly the factors the ATO will take into account when reviewing these types of situations. But also provides a whole range of examples as well, a whole bunch of different scenarios where you've got taxpayers involved in some sort of property development project and then trying to figure out what the tax treatment might be. Now, the focus of this guidance is very much on the revenue capital distinction, so whether someone is merely realising a capital asset or whether they're going beyond that and involved in a property development business or an isolated profit-making undertaking. So there is a lot of discussion around the factors you would use to determine that revenue capital distinction. The ATO then also discusses various different forms of property development agreement that people might enter into with other parties. And the focus there is really on determining whether the parties who might be coming together around a particular project should actually be treated as partners in a partnership, either a general law partnership, maybe a tax law partnership, maybe they're just joint venture parties, that could be a possibility. And in other situations, it'll be none of those things. It'll be just another form of arrangement between related or unrelated parties. It could be that the landowner is simply paying a fee to someone to help them develop their property. So that's the second part, or the second aspect of that draft guidance. We're looking at how we should characterise the interaction between different parties to a project. The guide also discusses timing issues. When should income be recognised? When should expenses be recognised as well? When people are undertaking various projects. As I say, there's a whole lot of examples that discuss a range of different scenarios. Now, at this stage, the guidance is only in draft form, and the ATO is inviting comments on that guidance, whether there's anything you strongly disagree with in terms of what that guidance represents, but also other situations where you feel that examples would be really useful. We've already made a submission to the ATO on that. We think there's a few areas where more guidance would be really worthwhile on some really common issues. For example, where someone goes from holding property on capital account into holding it as part of an isolated profit-making undertaking. At the moment, there isn't a great deal of guidance around in terms, in a formal sense, in terms of what you're really meant to do there and how the calculations might work out. So we're hopeful that the ATO will flesh out some of its guidance in those areas where a lot of practitioners struggle to kind of get any real sense of certainty on how those property projects should actually be treated. The ATO has what looks to be a pretty tight turnaround time on this guide. It's draft at the moment. It looks like the ATO is hoping to have the final version released around the end of August, which doesn't really give it a great deal of time to work through the submissions and come up with that final version. We're not sure what form that final guidance will take. Will it be some sort of ruling? Don't know. We'll wait and see. But again, for clients who are involved in property transactions, well worth having a look at this. In addition to other existing ATO guidance in this area and case law that already exists around this sort of area, it's just another source of guidance that might help you arrive at an appropriate and a correct tax treatment for those projects.
Now from the ATO, it's across to Michael to look at those FBT changes to the motor vehicle exemption.
Now, the ATO has released some further guidance around the FBT exemption for commercial vehicles. Now this is an area that's kind of been developing a bit over the last few years. For quite a while there wasn't a great deal of guidance out there in terms of how do we figure out whether a motor vehicle did actually qualify for the exemption under FBT system in terms of what was limited, minor, infrequent private use. The ATO then released some draft guidelines basically providing a safe harbour so that if certain conditions were met and the private use of the vehicle was very limited and within the parameters set by the ATO, then the ATO basically said, look, we'll probably leave you alone. We're not going to actively look at whether this does actually qualify for the exemption. You can assume that it does qualify. The ATO has now gone a step further and has basically said that the draft guidance issued last year, that will be relevant to the 2018 FBT year. But this new guide that has come out will be relevant for the 2019 FBT year onwards. Now this guidance is very similar to the version released last year, but there are some minor adjustments aimed at making it easier for employers to basically access the safe harbour that the ATO is providing. So first of all, you need to check whether the vehicle is an eligible vehicle. It needs to be either a vehicle that's not a car, so it could be a vehicle designed to carry a load of 1 tonne or more, that might be enough to make it not a car, or it could be another form of commercial vehicle that's not designed mainly to carry passengers. And there's a few different ways we can go about trying to figure that out. But once we've determined that the vehicle is eligible for the exemption, we still need to look at the usage of that vehicle. And to qualify for the exemption, private use has to be limited to home to work travel, travel that's incidental to that home to work travel, or minor and infrequent private travel. And the question mark is, well, what sort of diversions are acceptable when it comes to incidental travel on the way to work, and what is minor and infrequent? Now the ATO is basically saying that if you are travelling between home and work and you take a diversion, pick up a newspaper or something, and that doesn't add more than 2 kilometres to the overall length of the trip, well, that's acceptable. That still falls within the parameters of the exemption. When it comes to completely private travel, the ATO has said they're okay with it as long as the total private travel for that vehicle for that entire FBT year doesn't exceed 1,000 kilometres. But you also need to make sure that there is no single return journey that exceeds 200 kilometres. There are also a number of other basic conditions that need to be met. For example, the safe harbour won't apply if the vehicle has been provided under some sort of salary packaging or salary sacrifice arrangement. So if all those conditions are met, again, the ATO is saying that they're not going to kind of come down on employers and really actively review whether the exemption is available. Where there's a bit of a difference in this guide compared to the last version of the guide is that the ATO previously said that there's an expectation that employers would continually or regularly monitor the private usage of the vehicles. They'd get odometer records and they'd compare that to what they expected the employee would travel between home and work. The ATO has relaxed that a bit. What the ATO is now saying is that the employer needs to make sure that they have an internal policy. So a policy that severely limits private use of these vehicles, and that's provided and communicated to employees. Rather than the employer having to now monitor that on a regular or continuous basis, the ATO says it's sufficient for the employer to receive some sort of assurance from the employee after the end of the FBT year that their private usage falls within the parameters in the guidance. So the employer doesn't need to take as many active steps to check compliance with that. Now the ATO again says that, look, that needs to be a reasonable basis for you to assume that the employee's assurance is actually accurate and correct, which suggests that it still is up to employers to have a think about whether the employee is actually meeting those requirements or not. So employers might still want to take some steps. For example, total odometer records for the year, look at how much that vehicle has travelled throughout the year, and test that on a reasonable basis. Does that seem like it's reasonable compared to what you would expect the employee to be travelling between home and work with a little bit added on? So slight relaxation of what's required should make it a little bit easier for employers to be comfortable that that exemption is available to them. Now, if those safe harbour guidelines aren't satisfied, it's not the end of the world. It doesn't mean the exemption isn't necessarily available, but it means there's more risk around it. And it does mean that the employer will probably have the expectation on them of taking more steps to monitor actual private use by employees. And that might mean that a regular review is done, comparing actual kilometres driven with what you would expect the employee to be driving just maybe between home and work on a typical day. So slight relaxation of the rules for the 2019 FBT year onwards, and it should give some comfort to some employers where those conditions are met. For those who don't meet that safe harbour, beware. This is clearly an area that the ATO is looking at. It's an area that you can expect will be targeted at some point in the near future, if not already. So even for those who don't qualify for that safe harbour, this is a really good warning and a reminder that you do need to be quite careful around this area.
And now that new PCG that looks at uncertainty around the company tax rate. Remember also that Parliament doesn't sit again until August, and that's the soonest date we're likely to see that legislation pass.
Now, we've still got this area of uncertainty around company tax rates and maximum franking credit rates for companies for the 2018 year. This is something we've mentioned in the past, and it won't be resolved in the very short term because it's waiting on Parliament in terms of whether Parliament actually passes legislation that's been sitting there for a while now. And really the issue is around those companies with aggregated turnover of less than $25 million in the 18 year. Which method or which set of rules should we be using to determine what the company tax rate should be and what the maximum franking credit rate should be? Now, bearing in mind the uncertainty that kind of sits around that at the moment, the ATO has released some draft guidance in the form of a PCG, which is a draft one, which sets out, I guess, an administrative position to help advisors and companies manage that uncertainty, at least in the short term, until things are clarified. Now, the first thing that the ATO does is basically, I guess, acknowledge that there has been a change of view and some uncertainty around when a company might be carrying on a business. Right at the moment, that is relevant to determining the 2018 tax rate, but if the legislation passes, it won't be relevant to determining 2018 tax rates. So the ATO's focus in this guidance is actually on the 16 and the 17 year, because whether a company could qualify for the lower tax rate in those years was heavily dependent on whether it was carrying on a business or not. The ATO has basically said that it's up to companies and their advisors to make a genuine call on whether the company is carrying on a business. And the ATO has said that they won't devote compliance resources to actively go and try and figure out whether people have got that right or not. Now, of course, the warning from the ATO is if your conclusion is plainly wrong, then don't expect the ATO to agree with it. Likewise, if the ATO ends up reviewing or auditing the company for some other reason, well, it may then have a bit of a closer look at that issue around whether it was actually carrying on a business to qualify for the lower rate in the 16 and 17 years. So that's the first bit. The second bit of the guidance is around franking rates for the 18 year. Companies, if they were going to pay a dividend for the 2018 year, would already have done what they need to do in terms of resolutions and the like. For smaller private companies, they may not yet have issued their distribution statements to shareholders. But where they have, there is still some uncertainty around what the maximum franking rate would be for some companies, because it will depend on whether the new law, the proposed new law and the changes pass through Parliament. But what the ATO is doing now, which is similar to basically what it said last year when we had some uncertainty around 17 franking rates, is that if a company has issued distribution statements to shareholders and the law then does pass through Parliament and the position is changed, well, the company doesn't have to go to the ATO and seek the Commissioner's discretion to be able to amend the distribution statements. They can just inform shareholders of the changes to the franking rate on their dividends. The shareholders would use the information they've been given to then prepare their tax return, or if they've already lodged their tax return, to seek an amendment of the return. And the ATO has said that, again, in the ordinary course of events, if companies are informing shareholders of those updated franking rate details as soon as practical, then the company shouldn't really kind of face any penalty for having had to change that number. So the ATO recognises some of the uncertainty that exists right now at the moment. We're hoping that this is clarified pretty shortly when Parliament resumes, but who knows, it could still be some time before that actually happens. But at least there's a little bit of comfort from the ATO to say, look, they acknowledge that there is this uncertainty and they're giving a little bit of flexibility to companies to deal with this in a practical way.
If you're a member of Knowledge Shop, remember you have those New Year standards on the Knowledge Bank now. If you're doing self-managed super fund audits, I know it's a very tense year for you guys, those standards are up there now, the full audit program. Also up there is the New Year standards to help you deal with the tax and compliance requirements for your other clients as well. If you're not a member of Knowledge Shop, then give Julie a call on 1800 800 232 and she'll take you through exactly what's on offer. Speak to you soon.